A sale in a lending business is not completed when you disburse the loan. The sale is completed when the monies come back to you.
So how do you ensure that your money gets back?
पैसे collect करना customer से doesn't start when the customer misses an EMI payment. It is an industry which is cyclical in nature, as well as his opportunities or thought process in his future plans for his business with our folks. And that's when we kind of try and connect with the customer faster than what the industry will respond.
How much of your overall book is having an overlap with the microfinance space?
We are present in 46 cities in the country. Our goal will be to first penetrate the states where we are present. We are practically talking about just tier 1, tier 2 and a little bit of tier 3 towns. Most recently, if you see last week's announcement in terms of the Indian government tying up with the Japanese government to see how the entire MSME ecosystem can kind of deliver much more. So yes, challenges will continue to come.
Do you think from here onwards the NPS cycle would be in control, the collection efficiency would be improving?
Where we stand today, we've seen an improvement happening in terms of how collections have panned out.
How is the customer behavior different in the affordable versus the prime category?
Not too different.
How is your OPEX cost going?
We are in a very, very similar space. So our cost to income ratio for FY25 was 84%.
One financial metrics that you never compromise on. One Indian NBFC that you admire the most and why?
You know, the organization I started my career with.
IPO for RapidPay, yes or no and when? In your CIFL journey, one decision that you would like to go back and change in time. What has been your best decision in the CIFL journey so far?
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi Pinank, welcome to the podcast. Capital India Finance is into the lending business. And lending is a very commoditized business in India and globally as well. There's a huge competition and buyer is just focusing on who can give him the lowest interest rate. The raw material for all the NBFC is just money. So what makes you excited about this sector?
Hi Abhishek, very good afternoon to you and thank you for having me at the show. The fact that there's too much competition is demonstrated by one significant point, that the market opportunity is very, very large. And that brings in all the competitors into this space, trying to make themselves into a much larger institution. And to be honest with you, you rightfully said it's a commoditized business.
Yes.
But the beauty of this business is if you are able to build an institution with patience, it's likely to deliver very strong results. And that's what we have set our eyes on, to build an institution with a very, very long-term vision.
Okay. Your company is about 32 years old and they were into the financing from very long time. But company is right now into a complete different vertical. So how has the overall journey been and why so many pivots?
Well, I think there's only been one pivot, Abhishek, but let me just give you a perspective. Capital India Finance did get set up and registered and licensed way back in 1994. But it was only in 2017 and 18 that the current promoters acquired the company, infused capital, and then started building scale into this business. In the initial days, the focus was around wholesale lending as one key vertical which the company was trying to build. But pretty soon realized that we would want to scale much larger, and scale in this vertical only will come with leverage, and which was possible only if you had diversified into a much wider retail lending opportunity, which was kind of building up to speed during those days. And of course, the ILFS and Diwan debacles that happened and then. So the pivot actually has been only one, and we've been constant and steady with a very clear focus around building that vertical for ourselves.
Okay. What does the Capital India Finance do right now? Can you walk us through the business model?
So we are a MSME-focused lender.
Okay.
Our core focus is the India's growing MSME sector, and I think the opportunity there is so immense that we are just scratching the surface today as we speak. And for us, the big if I say the cream of the product kind of comes in from the secured lending vertical. Almost about 80% of our loans are secured.
Okay.
Where what we are essentially present in is the loan against properties space.
Okay.
And that's the space we are trying to build out as a lender, focused on MSMEs, focused not on consumption, but focused more towards business expansion of our customers.
Okay. Let's go a bit slow over here, Pinank. So who is your customer and what is the average ticket size you are lending to, and what is the end use of that money?
So we have two key products even within loans against properties, and you are aware that that market is pretty wide.
Yes.
So in that we are present in the prime loans against property space, where the average ticket sizes ranges from 70 to 75 lakh rupees.
Okay.
These are businesses with a vintage of more than 5 to 10 years, typically annual turnovers of between 5 to 10 crores, very well credit tested customers. But these are essentially folks who are wanting monies for expansion of their business, for working capital, and willing to offer a collateral of their residential property of the owner of the business, or the commercial property which comes in as security. So against these securities, we offer financing to these customers for their business purposes.
Okay.
So that's one vertical. We're also present in the affordable loans against property space, which is slightly lower ticket size, where the ticket sizes range from 9 to 10 lakh rupees.
Okay.
These are individual businesses whom we are financing, say in tier 2, tier 3 towns, or outskirts of tier 1 towns of our country. And these are customers typically who have multiple income sources in the family. You will have, say, the lady of the house running a provision store in the locality where they live. The husband in the family is probably working in some nearby factory, and the son or someone else is in the family is running a transport business. So there are multiple sources of income for this household, and we are financing them for the expansion of their businesses. So again, it's a cash flow based and end use driven underwriting which we are doing for these customers.
Out of your overall revenue, how much is the prime and versus affordable in percentage terms?
So prime for us contributes almost about 50% of our AUM.
Okay.
Affordable today contributes about 20% of our
20%. And what is the yield in prime and affordable?
At a book level, prime yields us about 14.5%, and affordable loans against properties yield us about 19%.
19%. And going forward, what would be your focus on? Is it prime or affordable?
It will be on both.
Okay.
And as you will appreciate, being present in the India's MSME ecosystem, you have to be present across the entire spectrum. Of course, if I was to chase ROAs, I'd love to be present in the high yielding space,
Right.
but you need to balance risks as well as see how scale is going to come. And we're not in the business where we want to, just distribute credit without understanding the risks associated with it. And in a lending business, it's very easy to open the taps.
Yes.
It's given a choice. Tomorrow morning, I can create a book which will start giving me growth of 100% year on year, but that's not the ethos.
Correct.
And a very fundamental principle to lending, which I've learned through my career, is the fact that a sale in a lending business is not completed when you disburse the loan. The sale is completed when the monies come back to you.
Right. So I was about to come only कि पैसा बांटना बहुत आसान है, but it's very hard to recover it. So how do you ensure that your money gets backed, and what is your risk profiling criteria in both the categories?
So collections या पैसे collect करना customer से doesn't start when the customer misses an EMI payment.
Right.
That process starts on how the culture is built across the country, across the teams in the organization, and what's the mindset and ethos with which the company is chartering forward in terms of right at the time of origination. Just to give you an example, I extensively travel to all our branches across the country.
Okay.
And during my travels, I also take the opportunity to meet customers, not just visit our branches and meet our employees, but I also try and visit customers. One of my such visits at a branch, knowing that I would like to meet customers, the local team there had lined up 4 or 5 customer meetings for me. And I said, no, I don't want to meet these 5 customers. I much rather meet a customer who's not very happy with our service. That took them aback, but nevertheless, since I had mentioned, they had to take me to a customer who was not so happy. And we went and met a customer at one of these branches, and he very, with excitement on his face, took us through his business, what he's doing, showed us his house, etc. And then came out the difficult question from the customer that, listen, I've been a good customer to you, I've been paying your EMIs, I want additional debt, and your folks are not giving me that money. And I tried to understand what the real reason is. I had to sit with a pen and paper in front of the customer, plot down his cash flows in terms of the income he's generating, his expenses, his household costs, probably future expenses, build up of his children's education and stuff, and then see what the residual cash flow remaining for him on a day-to-day basis is. Having understood that, I had to articulate to him that, sir, we'd love to give you money. You are a loyal customer, but I think the time's not right. If we do that today, it's going to be over leveraging. Why not wait a little more, and our team will be connected with you to come and grant you a loan as soon as your cash flows become better over the next 6 or 12 months. Let's just keep that in mind and build it forward. So we had to say no to giving a loan to an existing performing customer.
Right.
Now, in a competitive environment, it's very easy for this customer to walk away and go to a competition and say his financing needs will be taken care of.
Right.
But the genesis of asset quality starts, as I said, in the way in which the culture is built up. This was a very important message for us to be relayed down to our team in terms of the approach you take towards understanding the customer's needs and his ability and educating him rightfully instead of just over leveraging and doing a sale technique with the customer.
Yeah, let's double down on the risk profiling only. So last 2 years have been really tough for the MSME and specifically for the microfinance, right? I personally track almost all the companies in this sector. Look at SBFC, India Shelter, then other companies as well. All of them highlighted one common thing, that they are moving up the guardrails. They are focusing on high CIBIL score and also focusing on different regions where they see that the impact come hai. So in the last 2 years, have you also seen a pattern ki problem tha and how you tackled it?
So it is an industry which is cyclical in nature.
Right.
It keeps coming up with cycles. What is very, very important is where do you sit in the pecking order in terms of the customer's intent to repay your loan. It starts with twofold processes. One, underwriting the customer appropriately with the rightful buffers, which is what my earlier response to your question was alluding to understand the real cash flow the customer is generating, not just in terms of what data is reflecting in terms of his tax returns or bank statements, but going beyond that and understanding what kind of margins that business is going to be able to deliver. So we don't just take everything on face value. We have our own understanding of what a particular business is going to be able to generate. And once you've done that, you build that customer's journey with you across life cycles, across challenging times, and those buffers come handy when the customer is going through a cash flow crunch. So you have to start early. Having said that, yes, delinquency levels have increased. Fortunately, we are not in the microfinance space. We are again in the secured lending space and underwriting the customers on the basis of their cash flow. So these are the two big insulation points allowing us to ensure that the asset quality kind of continues to be upheld.
Okay. For the last 2 years, what were your gross NPA, net NPA trend and also the collection efficiency ratio?
So our NPAs have increased, but they are still pretty much well in the realm and better than the industry. Our net NPAs stand at about 1.3%.
Okay.
Gross NPAs at about 2.49%.
Okay.
So that's a number which we believe it's in line with the industry dynamics. But over a period of time, we would want to work towards building out a 2% NPA kind of a business as we. But these are again, as I said, cyclical businesses in nature. NPAs will be there, but I think monies do come over a period of time, and it's important for you to be in touch with the customer when he or she is going through a difficult time, and that's what our in-house collections team is continually in sync with. So we don't outsource collections as a function. We reach out to the customers directly and we are constantly in touch so that as soon as there are cash flow easing out for the customer, he or she is going to be able to repay the loans on time.
Okay. When you're lending to a customer, you evaluate that over leverage hai ki nahi. But what happens after he has taken the loan from you? And when he is not in a good situation, which happens, so he runs out to the other NBFCs and then they lend it to it. So how do you ensure that your existing customer is not over leveraged?
So there's very little as a lender we can do once the loan's granted.
Correct.
But what is more important is we need to keep our ears on ground, including keep checking the data for any early indicators for delinquency which may come up, etc. But let me share with you, industry generally in our country has been very, very conservative. There's been sensible lending approach which has been used by all lenders in the country. There used to be a time, probably 15, 18 years back, maybe just before GFC, where people had taken certain calls over leveraging and stuff. But today people are rational when it comes to lending. Yes, there is rampant competition. There is going to be a lot of, balance transfers as you used, except the word that you used. But it's still rational in terms of their lending decisions. So lenders themselves are a little cautious if the customer's over leveraging is happening. And I don't see irrational credit decisions being taken by them. But from our perspective, we keep our ears on ground. It includes, checking if customers inquiring often for a loan in the bureau. data is now the moat which everyone talks about. So there is these analytics which are being run at the back to understand if a customer's intent to borrow is there, if he or she is underlevered, if there is a scope for us to give a higher loan to that customer, etc. We would ourselves reach out to the customer. And the second aspect also is the fact that our people are in constant touch with the customers in terms of understanding and seeing how his business is evolving. So when you sense any difficulty that the customer's facing, and when the employee of our company, our folks, have had the connect with the customers, that's when you realize that the customer is going to be forthcoming to discuss his challenges as well as his opportunities or thought process in his future plans for his business with our folks. And that's when we kind of try and connect with the customer faster than what the industry will respond with.
Okay. How much of your overall book is having an overlap with the microfinance space? Because microfinance has been very badly hit. Right now, seems that the cycle has turned. I will come to that question also. So, because microfinance people are also the MSME borrowers as well. And if the person is over leveraged in the MFI space, or I would say unsecured lending. So how do you assess that? And if you get to know that my existing borrower is being over leveraged, then what are your actions?
So, a significant proportion of our customers really will have a microfinance. That's not our target segment, to be honest.
Okay.
Just to give you a flavor, we are present in 46 cities in the country. And, we are practically talking about just tier 1, tier 2, and a little bit of tier 3 towns. So microfinance is very, very limited, especially for our customer segments whom we are targeting. Yes, our customers would have multiple loans. It could be an unsecured loan. It could be a two-wheeler loan. It could be a mortgage loan already running. It could be a personal loan. So, but that all weighs in our credit underwriting in terms of the cash flows which we look at, etc. And we try and ensure that those insulations are done, be it in the fixed obligation to income ratios as the industry kind of looks at and stuff. We try and be a little conservative around that to ensure that the buffers for the customers' daily cash flows are created well in advance.
Okay. Pinank, walk us through your profile as well, because a CEO is a very key person, especially in the banking profile. He can make or break the organization. So walk us through your experience.
Well, you talk about a role of the CEO. Obviously, you will have all the management responses to that. But to be honest with you, the key role for me, the way I look at it, is to build the culture in the organization. And building culture does not happen sitting in a corner room in your offices in some of the cities. You need to be out there talking to your colleagues across the country, and that's what is an approach which I imbibe in my engagements with my colleagues. Including not just visiting our offices and traveling extensively, but doing it the way our colleagues would do. For example, if I visit a city, I'd love to, rather than sitting in the comfort of a car, even if though it is 40 degrees outside, I'd like to go on a two-wheeler with my colleague whilst traveling to a customer or traveling to a channel partner or wherever. So the whole idea is, can people connect with you in your organizations? Can they believe that you are a people-oriented organization? And that really is the genesis of how we are trying to build the culture in our company. And that, to my mind, is the single biggest enabler for building a large financial institution.
Okay. And we have seen that most of the CEOs, I would say, without naming anyone, they have a very good organization. Everyone has it. And we have seen that in a very large organization, especially harassing the employees in terms of having calls at 11 or 12 in the night and then in the morning regarding the recoveries and all. So how do you ensure that the healthy culture is there in the company?
So my message to my colleagues across every town hall which we do, or whenever I meet my colleagues, is first and foremost, try and give yourself enough time with your family and have a healthy work-life balance. As far as possible, I try and see that I don't want people sitting back late in office. So these are, you walk the talk, but at the same time, you don't put unnecessary pressure on people asking these questions at 11 p.m. in the night. Having said that, businesses always get built with passion, and when you start believing that the organization which you are working for is your own home, that's when these distinctions get blurred completely, and people are happy to contribute. And that, for keeping them happy, you have to make people believe that this is their family. And we take initiatives to engage with our colleagues across the country such that that belief kind of gets built into an ethos.
Okay. Beyond lending, you have two other subsidiaries as well, RappiPay and Remitex, and also your housing finance that you sold. So walk us through their journey as well, and what is their role in the overall company?
So, initially you just spoke about how we were looking at transformation into this business, maybe from wholesale lending to retail lending. The big picture goal was to build a financial institution. And a financial institution which is going to be resilient to all the challenges coming across industry from time to time. In that intent, our first principle was to ensure that corporate governance kind of gets enhanced. So we have a very, very strong board of directors. The second step which was taken was to ensure that the capital position into the company is more efficiently used. That's when we chose to hive off our housing finance company and sold the company last year, freed up that capital for further scaling our lending business. With that behind us, as you rightly pointed out, there are two other verticals which are present. We have a 52% equity in a PPI licensed fintech business called RappiPay.
Okay.
RappiPay has a very large customer franchise, almost about shade under 1 million merchants which they are talking to across 17,000 pin codes in the country. And that's a business which is kind of being built more keeping banking as a service in perspective, as well as offering them short-term business loans to these customers. So they are essentially acting as a digital lending partner, not just for us, but for multiple other NBFCs in the country.
Okay.
And it's a technology business. We've invested heavily into that business in RappiPay. Fortunately, through the last 3 years, if you see year on year, they've kept improving in terms of their margin. They've turned EBITDA positive last year as compared to a loss in the previous year. So directionally, that's a business which is coming up the curve. And we also have an 82 license in our NBFC, which is Capital India Finance itself, for running a forex remittance business, which is not a capital guzzler, but it's a more fee-based income which kind of gets generated. That's where we have a distribution network of almost about 38 branches across the country.
Okay. And RappiPay is into unsecured lending, right?
That's right.
And you are pivoting towards the secured lending.
That's right.
Okay. So eventually both of them would be running, right? And do you have plan to completely acquire this subsidiary, or would it be 52%?
No, we don't intend to make any further equity investments into RappiPay.
Okay.
We hold a 52% equity and they have other investors who are there. It's an unlisted organization today. They are into unsecured lending, but they are into unsecured lending of a shorter duration for business purposes. And it's not, whilst it's a fintech business, we like to call ourselves phygital. What I mean to say phygital is a customer by himself or herself can't do the entire end-to-end journey by themselves to take a loan from RappiPay via RappiPay. They will have to be assisted by one of the executives to help them go through that journeys. The point I'm trying to make here is there is a touch point with a customer and thereafter the entire delivery is digital. That ensures that there is recognition in the customer's mindset that there's somebody coming onto their door, and thereby their intent to repay kind of gets even more re-emphasized. And that kind of tries and augurs well for us. And as I said, our focus at Capital India Finance is the secured lending business. Unsecured is something which we've defocused from. It's a small part of our business, and that's how it will remain.
Do you also cross-sell to the RappiPay customers the secured lending part?
So it's a very big opportunity for us. But as I touched upon, RappiPay is present in almost about 17,000 plus pin codes in the country. And we are at Capital India Finance, we are giving loans only at about 46 branches and 46 cities in the country. So there's a long way to go, but it's an opportunity which we will definitely be continuing to work towards.
Okay. Pinank, you are the CEO of Capital India Finance Limited. And in the finance or lending side, CEO is a very important role because he can make or break the organization. So walk us through your journey, and why do you think that your current role fits you basis your past experience?
So Abhishek, one very important lever for any leader, I strongly believe, is physical fitness.
Okay.
I believe as an individual, if you are able to deliver on physical fitness and take care about yourself, I think that automatically translates into the fitness of an organization. That's point one. Point two, and very important barometer for me, is how is it that we can build a culture in our organization? How people friendly can we be? And I very strongly believe that lending as a business is a people-oriented business. Of course, there's technology, of course, there's talk of AI and all of that, but the human element in lending can never go away. And hence, it's important that you start building a culture. So if you care for your people, if you help people in their work-life balance, that blended with fitness, I think is a journey which demonstrates a lot more in terms of health of an organization. Personally, for me, whilst I've been passionate about hiking all my life, but the last 4 to 5 years of my life have been a complete makeover in terms of a personal fitness journey. Not only have I, expanded my hobby of hiking into trail running, but I've been able to do that with a very consistent approach, and that consistency has helped me build endurance and resilience in the approach which we take in running an organization. And to be very honest, people talk about transformation for a company. What the outside world sees is a transformation, but on a day-to-day basis, there are waves which are being faced by the leaders in an organization and the organization, and how you fight those waves is a story of resilience, can only be learned from actually living it.
Okay. So what are your past experience in terms of your journey, where you were working and how that experience is helping you today?
So I have been fortunate to start my career with the mortgage major HDFC Limited way back in 2002. I spent under a decade there, learning the building blocks of the mortgage financing business in our country, and who better than HDFC Limited to learn that from. A beautiful organization led by some amazing leaders from whom I have kind of taken a lot of learning, including the risk related and people related inputs which have come from leaders at HDFC have kind of built my ethos towards running an NBFC. Post HDFC, I joined a company known as Indiabulls Financial Services as the head of treasury and investments. Raised large amounts of funds for that organization during the period that I was there, and thereafter leaned into a new role in 2017 to set up a fintech-enabled lending business called Dhani, where we had scaled to about a 9 million kind of customer franchise through the course of 5 years. And of course, swiveled that business into multiple other verticals. So in a journey of almost about 2.5 decades, I've kind of seen the entire spectrum of how a strong process-oriented organization runs, learning that and implementing into a, so to speak, new age business which is trying to build itself, scaled there as well. And at the same time, seen how a technology evolution can take place. So this, to me, has given a very sharp edge in terms of understanding on what I would want to do in this play field for Capital India Finance.
Okay, really great experience. So right now, how is the economic condition for the MSME sector is the worst behind?
So, it's been a little tricky the last couple of years.
Right.
Whilst FY25, people kept talking about stress in unsecured lending to MSMEs and all of that, and some of the actions from the regulator also depicted in FY25. But if you see FY26, despite the geopolitical situation being uncertain, except for the last quarter of FY26, generally the trend has been reasonable. I very strongly believe that, yes, of course, there will be small hiccups here and there, be it the impact of the Middle East war, which has been ongoing, be it the choking of supply chains, etc. That can lead to some bit of stress for MSMEs. But I am a strong believer that I think our country has a lot of resilience when it comes to MSMEs being able to perform. That's also demonstrated in, most recently, if you see last week's announcement in terms of the Indian government tying up with the Japanese government to see how the entire MSME ecosystem can kind of deliver much more. And I think when we talk about MSMEs, people very start believing that we are talking about large manufacturing, but the real engine for our country is in those small micro entrepreneurs as you go on the street in small towns, even in tier 3, tier 4 towns, and you will see they are throbbing. So yes, challenges will continue to come. But I think we have enough and more resilience in our entire MSME ecosystem for us to be able to tide over it.
Do you think from here onwards the NPS cycle would be in control, the collection efficiency would be improving, and the last 2 years, I would broadly talking about across the industry, that phase has been over, and from here onwards the journey would be improving?
So, interesting point here to note is about 12 to 18 months back, people were talking about a major crisis in the microfinance
Yes.
world. And if you see the last 12 months now and where we stand today, we've seen an improvement happening in terms of how collections have panned out. Similarly, I think MSMEs also have evolved through a cycle. Yes, there may be some challenges. There may be a quarter or two of slightly elevated delinquency one might observe. But in the long run, I think the resilience is pretty much built up and nothing which the Indian banking system should be concerned of.
Okay, perfect. And how is the customer behavior different in the affordable versus the prime category? And when there was stress in the economy, how these profiles behaved?
So, not too different, because in both situations, the customers mortgage their prime property
Okay.
to a lender like ourselves. So, whilst there will be slightly elevated delinquencies in the affordable space by virtue of the fact that it's a high yielding asset class, but generally when a customer is kind of offered the prime collateral as their house, that's where delinquencies keep being in check. What is important is to reach out to customers in time, to be engaged with them, understand their challenges and start finding solutions for them quicker. And you have to be there standing at the customer's doorstep to ensure that you are the first to take the EMI from their pocket if
Right.
he is a levered customer. So, and that happens when you are in constant touch with them. I think that approach does help solutions come. In the prime space, the solutions come quicker by virtue of the fact that the marketability of the property is much higher. In the affordable space, the process is slightly longer, but if your underwriting has been done right, you've understood the right buffers, even though there is a difficult cycle which a customer is facing, he or she will turn around and eventually come to repay their loans.
If I look at your asset under management, it's around 1200 crore.
That's right.
And year over year, it has grown by like approximately 20%, right? And if I look at the other MSME players who are into the affordable category, they are growing at north of 30 to 40%, controlled with the like our gross NPA as well. So why you are having such a less growth?
So, Abhishek, point to note here is we did grow in FY26, but our AUM grew by 22%.
Yes.
But this was compared to flat or absolutely meager growth in the previous year and no growth at all in the previous 2 years. So, this is also in terms of how we are reorienting ourselves as a business. So we've been, as you are aware, we've continued to work towards running down our legacy book, which we had done earlier, be it some bit of education loan, which we'd done, be it some bit of wholesale lending we had done, and some of these other products. So we have continued to run them down. But what real answer lies in our AUM growth is beyond that in the disbursement numbers. So our disbursements grew almost 60% year on year.
Okay.
So we've grown in our core area where we want to lend, but we've shrunk some of the other verticals which we've not been wanting to grow further. And that's why the resultant AUM growth has been slightly slower. So 22% is on the back of that 60+% of disbursement growth in the last year.
And from here onwards, what is your 1 year, 3 year, 5 year, or long term target for the AUM for the shareholders that you want to highlight?
So I may not be able to give you quotes around specific numbers, but let me put it in perspective. We have built a very strong foundation last year. We've expanded our distribution network to 46 branches from 29 in the year prior. We've almost doubled up in terms of people in our lending business in a 1 year period. So we are now in a very solid frame right now to continue to pedal strong growth. We will always be having ears on ground to ensure that there are no risk bubbles which are kind of building up into our portfolio which we are generating now. And keeping that in mind and years on ground approach, we should be able to give a very consistent return and strong growth rates going forward.
But still, any number or target that you won't highlight?
We'd love to grow faster than the industry for sure. So, anything which is 1.5 to 2x of what the industry is growing, we would want to aspire to go towards that or even higher.
What is the industry growth rate?
You're trying to put words here, but let me put it this way. If I was to respond to say that 3 years hence, how is it that people should look at Capital India as a company?
Okay.
I would want numbers are an outcome. I'll be very honest.
Okay.
We would want to be recognized as an institution who has delivered consistent numbers through and through this period. And that's what the goal is. All going well, we would definitely want to hit the pedal faster than what we've grown in the past.
Okay. And would you like to highlight the gross NP, net NP numbers and ROA also? What are your targets and what is your current ROA?
So our gross NPA stand at about 2.49%.
Okay.
And net NPA at about 1.3%. What this factors in is these are blended numbers for our legacy business as well. But as we go along, we are definitely looking at a much stronger return metric. Just to give you an anecdotal response, last year, in an environment where spreads have been compressed for some of the other players in the market,
Yes.
our spreads have actually expanded. That has been because of two reasons. One, our cost of funds have continued to come down. We were operating at a stock cost of fund of about 10.82% as of March 25. That dropped to about 10.22% as of March 26.
Yes.
And at the same time, we have been able to maintain our yields on the asset side, thereby spreads expanding to above 500 basis points as compared to between 450 to 500 basis points earlier.
Okay.
So our spread expansion has happened through the course of last year. Our liability profile has gotten stronger. And very honestly, NBFC as a business is a liabilities business.
Yes.
It is all about how you're able to create an institution in terms of your borrowing principles, etc. Last year has been a landmark year for us for two reasons. One, naturally, we monetized our investment into our housing finance company. And also the fact that we are back to growth from the earlier stagnation we had seen in our AUM metric. And always you will see that, there's in a retail lending business, you need to set up the costs upfront. Expansion happens, thereafter followed by AUM growth. That's followed by income growth, NII growth, and that eventually results into profitability growth. And that's a game of few quarters. And I think we've laid that foundation for us to be able to reap those dividends in times to come now.
I will come to that question again. But coming back to my first question regarding your gross NPA is around 2.94% and net
2.49%.
2.49, sorry, and net is around 1.3%. So would you like to give any particular number that your numbers would be below it? Any code like?
So whilst the present level of gross NPAs will continue to remain, we should be in the 2.5 to 3% kind of a range as we go along.
Okay.
But in our long-term goals, as we see stabilization and complete runoff of our legacy books, we would expect our NPAs from our incremental new book, which is there, to be hovering around 2%.
2%, okay. And you highlighted that your spreads improved. So for audience, those who are for first time understanding about the fintech or finance or NBFC business, Capital First borrows money at 10.22%, right? And lends at 15.28% basis your PPT. And you are making a spread of 5.06% in between. You highlighted that your spreads have improved, which is a good thing. But if I compare it with your peers, they're having 8 to 9% of the spreads as well. Why are you having a less spread? And I would also say you are like focusing more on the prime side. If you'll focus more on the affordable side, then automatically your spreads would be higher and ROA would be higher.
You're absolutely right, Abhishek. And, all of us would love to build a high ROA company, but one needs to appreciate the life cycle in which the company is today. What peers you compare us with are playing in a higher yielding market, even in loans against properties or even in the affordable loan against property. The spectrum is pretty wide. People operate from 18 to almost about 25-26%
Yes.
range. We are in that lower risk and reasonable return kind of a metric. Going along, as the growth kicks in for us, we will definitely want contribution from the affordable loans against property space to increase in terms of contribution. But that's not something which one can do overnight. It needs to be built over a period of time. And that's what we are building for. Our whole ethos is we want to do profitable lending, whichever area we are operating in. And that's something which will start yielding returns as the productivity levers start going up. Today, we've laid that foundation, made the required investments in setting up the distribution framework, ensuring that the people are in place, ensuring that the processes are in place. And over a period of time, you start yielding those returns. And yes, there is a long way to go for us in terms of our ROA journey. But I think another 3 to 4 years and we'll be there in that space where people would expect us to be.
Okay. And what is your current leverage ratio by, I would say, asset by equity?
So our net gearing is just about 1:1.
Okay.
And there's a long way to go for us to be able to lever up further. we have enough and more equity buffers. Our capital adequacy ratio is standing at 40%. So there's enough headroom for us to be able to grow further without needing any further equity. So we should be able to continue levering up our business through the course of next couple of years, and then take it from there depending on the kind of growth we've delivered, and reassess the position from 2 years from now in terms of how we would thereafter want to fund our future growth. Obviously, part will have to come through equity as we've achieved a certain threshold. Maybe at around 3.5 times leverage is when we would want to start looking at raising further equity.
Okay, 3.5 is a comfortable range, right?
That's right.
Okay, and what is your current ROA?
So our return on asset today, you should not look at, because those numbers are, if I remove the extraordinary gain we received last year, they will practically not be there because we are in a growth stage right now. But at a stabilized level over the next 3 to 4 years, we would want to be at give or take around 4% ROA.
4% ROA and 3.5% leverage, roughly 12 to 15% ROE. That is your.
That's the number we
Maths.
would want to build the company.
In
for.
how many years?
That's we are trying to build it out in the next 3 to 5 years.
Next 3 to 5 years. Okay. And as we discussed upon the PAT, like you mentioned, so your FY26 PAT was 40 crore, which was a one-time gain. So when the investors can expect the profitability, you highlighted that in 3 to 5 years you will profitable, like making good ROE. So, but when it would start ripping in.
So Abhishek, one indicator of profitability, you should also look at how our interest income has grown quarter on quarter. So if you compare March versus December versus September, there's been a meaningful quarter on quarter growth in our interest income. We are running elevated today in our operational expenses because of the fact that we've laid a very strong foundation for future growth. By about FY27, you should start seeing FY28. You should start seeing a significant improvement in terms of our profitability matrices. Even in FY27, we should be able to get much better performance as compared to previous years. Last year was an aberration for two reasons. One, we had an extraordinary gain from sale of our housing finance company, and two, we had an accelerated write-off happening for some of our legacy assets, which did take place. Though the recoveries on that will happen, but those were more technical in nature, and recoveries will keep coming through the course of a few quarters.
Okay. And how will the FY27 look like?
In terms of
AUM growth, NPAs, and obviously the profitability, we should expect this year or not?
We should expect profitability this year.
PAT level positive.
Absolutely.
Okay. And AUM growth.
So as I said earlier, we would want to be growing faster than the industry. Last year we grew at 22%. Our aspiration will be to grow faster than what we grew last year, as well as what the industry is doing.
Okay. And one question that is very prominent, if you will look at the con call of all the companies I track with. So the state level protection law, that is the ordinance, has been the issue in the Karnataka, Tamil Nadu, and also Bihar. And these not just only affect the microfinance, it also affect the MSME also. True. So how do you see this risk, and how do you assess it? In those particular region, what is your exposure?
So as I said, years on ground is the first strategy, and for which that doesn't happen just by people sitting in the corner office. It needs to be happening from what we hear on ground. For example, our credit policies get framed for respective states basis feedback from our local collections team. So not just business, not just credit, but the local collections team will give us a flavor that this particular locality or this particular pin code is prone to higher delinquencies, etc. And we constantly keep reviewing that on a time-to-time basis advisories released by our risk team to our respective credit underwriting teams in the country. So a constant year-on-ground approach is something I believe keeps you, mirrored to what the real-life situation is on any of such difficult conditions, like an ordinance in a particular state leading to higher delinquencies, or habits getting formed for customers not to pay their EMIs on time. That can only be tackled if you are ahead of time in terms of when that situation is going to hit. We are extra cautious. Just to give you an example, we keep one interesting barometer in mind. If there are elections coming in any states in a particular year, our credit policies there are tuned in appropriately. Maybe create a slightly stronger buffer in the cash flows for the customer or in the loan to value ratios when we are offering loans. So these kind of steps, these are more like corrections which we keep doing from time to time basis our learning as well as the learnings from the industry that allows us to be on the ground. But to the specific examples which you gave, we are currently not present in the eastern part of the country. Even in Tamil Nadu and Karnataka, we just have one office each. Okay. So our deeper presence is in some of the other states.
And how, in which state you are seeing the most risk right now in terms of lending? The asset quality, or I would say delinquency, are the highest in which state?
So our experience has been pretty much in line with what the industry has seen, but largely even across the country. Gujarat for us has seen a slightly elevated delinquency level, and we have been a little cautious around building our AUM in the state of Gujarat. But with the right kind of balances, we still see opportunity there for us to be able to do that. But aside of that, it's largely been pretty even.
Okay, and in the state where the ordinance was there, like especially Karnataka, Tamil Nadu, you are like lending or you are a bit cautious?
We are lending, as I said, but as I said, we just have one office each, one in Chennai and one in Bangalore at the moment. So in terms of our exposures, it is limited. Karnataka has been performing well for us. We haven't seen any negative impact of this ordinance which you referred to.
Okay, and what are your target areas in next 2-3 years? In which geographies you are planning to go aggressive?
So, Abhishek, we are today present in 9 states across the country. Our goal will be to first penetrate the states where we are present further. There's a big opportunity which is there, and we're just scratching the surface. So we'd like to build our presence stronger into the states where we are present. And once we've achieved certain critical thresholds, thereafter, I'd like to further expand into newer states. But big picture, I think in the next year or two, we are not going to add many states. We may add branches, but states will be limited to where we are. Maybe one more state getting added over the next 2-3 years.
Doubling down on existing geographies.
That's
only.
right.
Okay. And how is your OPEX cost going? How's the trend and how will it look like in future? Because I will highlight that initially when the bank or NBFC in the CAPEX stage, that's also the major reason they don't have PAT growth.
True.
And once the operating leverage kicks in, from same branches you are lending more, then automatically the operating leverage kicks in.
We are in a very, very similar space. So our cost to income ratio for FY25 was 84%.
Okay.
Last year, the cost to income ratio was even higher because we invested more into these expansion which you started to do. But if I was to look 3 to 5 years from now, I think our cost to income ratios should drop to about 50%. That's what we'd like to build it out for.
Pinank, how would you ensure the sustainable liquidity in the company, and what are your plans for funding, be it equity or debt?
So Abhishek, the first and foremost fundamental principle of a non-bank lending business in our country is to ensure that the liquidity buffers are intact. And we have followed this principle very diligently through the course of last so many years. I think in a country where wholesale lending is wholesale borrowing is the only way in which an NBFC can go and raise funds, needs you to insulate yourself against any liquidity shocks which may arise. And we've built such resilience in those cash buffers at Capital India Finance that even tomorrow, if the markets were to lock down and liquidity is not available, we are not going to be running around, looking for liquidity. We'll be able to easily sustain through those difficult periods. So I think that's one principle which we very strongly follow. And the strategy there is simple. Through the course of last couple of years, we've expanded our lender franchise. We've added more private sector lenders across the spectrum in our lending tables. And we've also done an inaugural issuance of a NCD last year. And we would believe we'll continue to diversify our sources of funds as we go along. So, and especially operating at just about net gearing of 1:1, I think there's a long way in which we can continue to improve our gearing numbers. That's about debt. Equity, as I touched upon earlier, we are under levered today. So there's enough and more runway there for us to be able to continue to gear up. But yeah, at any leverage number of give or take 3 times is when we would look to raise any further equity.
Okay. Can you walk us through your cap table? Because in NBFC, if there's a strong promoter backing, then the NBFC can take huge leverage. And if the promoter backing is not that strong, then generally we have seen that the leverage ratio is not that high.
So Abhishek, our promoter is a gentleman called Mr. Sumit Kumar Narwar. He owns about 72% of the company. He's a first generation entrepreneur. Aside of Mr. Narwar, we also have a few family offices who have invested. One is, the RJ Group, Ravi Jaipuria family office. We also have Dharampal Satyapal Group. We have the DLF family office. Some of these HNIs have invested in our company, and we are a publicly listed company. And the number of shareholders in Capital India Finance has increased through the course of last couple of years. As we moved from a single listed company on the Bombay Stock Exchange to a dual listing since April last year onto National Stock Exchange as well. So, overall, we've continued to improvise on our shareholder roles, and as we continue to grow further, the opportunity is immense, as I've already touched upon.
Okay, nice. Pinank, let's start with the rapid fire round. Are you ready?
Sure.
One financial metrics that you never compromise on.
Liquidity.
Okay, and why?
Well, as I said, wholesale financed institutions in our country, liquidity tends to get locked up from time to time. That's a principle which is very dear to our heart, and we want to ensure that we build an institution in the long run rather than looking at shortcuts for a quarter or two.
Okay, one Indian NBFC that you admire the most, and why?
Many companies, but the organization I started my career with, which I admire a lot, that's HDFC Limited, and for two critical reasons. One, for the entire ethos and mindset around people, and two, the conservative lending approach with which foundation was laid for such a large institution to get created in our country.
Okay, IPO for RapidPay, yes or no, and when?
Yes, at an appropriate time.
Okay, in your CIFL journey, one decision that you would like to go back and change in time.
Well, answer is none actually. We're pretty
Okay.
happy with the story we've been able to set and charter for, and I think we're on the right path for growth to come along in times to come.
What has been your best decision in the CIFL journey so far?
To ensure that stakes on corporate governance are pretty high, to take a very wise board which has got set up, and the advice from the board to continue to build our company from practically from scratch, and more importantly, not get swayed by an aggressive growth need, which at times the market kinds of tells you in a short run. We would much rather build an institution in the long run. Growth will follow, but it's important to get the building blocks right for that growth to follow.
Yes. One habit that made you successful.
Fitness and a never say die attitude to all the challenges which keep coming on your day-to-day journey.
Okay, if you were not in finance, then which stream would you be in?
Well, I would most certainly be living in the mountains, hiking around in the Himalayas.
Okay, Pinank, one last question before we wrap it up. If a company wants to start into a NBFC business, what would be your advice to have a successful business?
Well, one needs to be having a strong attitude of perseverance across challenges which will keep coming. It's important to get your people, product, and processes right. Not worry about short-term gains. Once you've built this foundation, profitability will follow over the next few years as one is able to deliver growth.
Pinank, this is all I had. It was a pleasure speaking with you.
Thank you, Abhishek. Likewise. Thank you so much for having me.